Today we got the one and only Rick Rule. If you do not know who Rick Rule is the CEO of Sprott, multi-billion dollar investment natural resource company. Rick has made billions of dollars for his clients. You may not know of him as much because he's not out in the media as much, but I assure you, you are listening and are going to be hearing from one of the most famous and successful, most importantly, natural resource investors in our modern age, someone who's the CEO of a multi-billion dollar firm who's kind enough to come on here and talk to us. Before I let Rick say hello, I do want to mention sproutusa.com/rankings. Rick is generous enough to give free advice on natural resource portfolio where he'll re-rank your stocks for you if you have them and you send a message over, and it's sproutusa.com/rankings. So without further ado, we have the one and only Rick Rule. Rick, thank you.
Thank you for the introduction. I need to correct you. I'm not the CEO of Sprott. I'm the largest shareholder. The CEO role is reserved for a younger and more vigorous participant. I am
was this recently when you stepped down?
I'm sort of the gray eminence.
This was recent, though, that you stepped down, wasn't it?
No, I am the CEO of Sprott U.S. Holdings, but the CEO of the parent company is a younger person.
Okay, so the title of this video is going to be something like, is this the most profitable investment of 2020, 2021? It's going to be something like that, right? And the reason I wanted to talk to you again is because as I've been looking more and more into uranium, and you see 60-70% of the supply being shut down, 20-25% of our power comes from it, and I'm looking at these stocks and I'm like, how are these stocks pennies for how important this is? And I was hoping you could give us your thoughts right now on the uranium market, paint us the picture for the bull market for people who feel like maybe right now they're listening to something in Spanish because they never even heard of this. So start and give us the macro bull market view and your take on it right now.
Well, uranium is a favorite investment topic of mine. Favorite because the last recovery from an oversold bear market, which occurred in the period 2000 to 2006, was the most dramatic financial experience of my life, which is to say that I made the most money from a fairly small start that I ever have, both on my own behalf and on behalf of clients. It's a great topic too, because as a contrarian investor, which I am, and which any natural resource investor must be, uranium is actually, in my experience, the ultimate contrarian investment. When uranium is out of favor, it's way out of favor, and the cost of the cost of the material, the price of the material, falls well below the price of production, which means over time that the markets work and supply and demand becomes balanced because supply falls. But it's better than that. A contrarian looks for a commodity that's unloved. Well, uranium isn't unloved; it's hated. When you speak about uranium to generalist audiences, particularly young audiences, your audience, they don't think of financial opportunity. They think of Fukushima, Hiroshima, Nagasaki, Chernobyl, 3 Mile Island. I remember when I began talking about uranium in 1999, not only did the generalist audiences die of boredom, but a small fringe of those audiences attacked me almost physically for attempting to profit off the misery of mankind. They weren't smart enough to attack the political leaders who had pushed the button, but rather attacked a commodity that was responsible for the fact that the lights go on. And the lights going on is really what this story is about. I can make things very simple for your generation that hasn't been through uranium recovery, and in fact, hasn't had to trouble themselves too much with regards to natural resources. Even in ostensibly rich countries like the United States, which believe that they can transition to wind and solar and more politically correct sources of power, Uranium provides 15% of baseload demand in the United States. The Rural Electrification Administration in the United States believes that a mere 3% surplus of electrical capacity rather than demand leads to widespread blackouts. So if there was a constraint to uranium supply, which is 15% of baseload demand, the outcome would be that the lights would not come. Simplified, investors of your age, in fact, investors of my age, need to ask themselves a simple question. Do they believe that 5 years from now or 6 years from now, when they get up in the morning and they hit the light switch, that the power will come on? Because if the answer to that is yes, unless they happen to have a Tesla roof and a $40,000 battery pack in the garage, if the answer to that is yes, then they believe that the uranium price will go higher. Let's take that a step further. It is believed by industry experts that the worldwide cost to produce a pound of uranium, this is total cost, not just the mine site cost, but cost of capital, exploration cost, prior year write-downs, all those things, exceeds $50 a pound. So right now, the industry makes the stuff for 50 and they sell it for 30. Being miners, they try to make that up on volume. They're losing $20 a pound, 100 and something million times a year, and it's been getting boring, to say the least. This extended period of very low uranium prices has put the marginal producers out of business. Goodbye. But it has also greatly reduced the production from the two largest producers in the world, which is to say Cameco, which shut down Cigar Lake, the world's biggest uranium mine, and Kazatomprom in Kazakhstan. So the impact of low prices has already been felt on production and will continue to be felt. And this is really where the opportunity is. Because when you shut down a big uranium mine like Cigar Lake, when you balance supply and demand by reducing supply, when the market tightens and the material begins to increase in price, you can't bring that supply back online quickly to match the pricing signal. It takes years and billions of dollars. I learned that in the last cycle. I remember thinking in 2000, when the arithmetic was similar. In those days, it cost about $30 a pound to make uranium, and the industry was selling it for 10. And I thought the price has to go up or else the lights will go off. Well, the first thing that one learns is that, yes, it has to go up, but it doesn't have to go up immediately. There's an enormous difference between inevitable, which is true, and imminent, which is not. But what I had thought was that, the uranium price is going to have to go above $30. It might even hit 40. Maybe it'll hit 50. Well, I was wrong. It hit 150. What that means is that if you have a substance like uranium, where the price of the commodity is such an infinitesimal part of the finished value of the product, and let's make that easy. Uranium in a modern nuclear power plant, the fuel cost is generally less than 3% of the gross sales. So if the price of uranium doubles, it has no impact on the finished price of the fuel. If it triples, it has no impact on the finished price of the fuel, in fact. So my thesis to your listeners will be, in the first instance, if the price of something has to go up, and it can go up, it will go up. The other thing to consider is that in 5 or 6 years, the lights go out. And I think it's extremely improbable that the lights will go out. I think it's much more probable that the price will go up. The caveat I have with that is, as I say, I've learned painfully that there is an enormous difference between those two words in English, which are inevitable and imminent. Yes, it has to go up, and no, it doesn't have to go up right away.
Very interesting. And how does, first of all, I've heard you talk about it before, but give me an idea of the types of returns that you and your clients got during the last bull run where it went from 8 to like 150. Give me an idea of that. And for people that, they have no idea.
Well, that's almost unfair. And I need to begin with the caveat that I don't expect this upward price momentum, pardon the pun, to be so explosive. But in direct answer to the question, in 2000, we'd been through a 20-year bear market in uranium. There were only 5 small mining companies that had survived that 20-year bear market. Mercifully, we bought large positions for ourselves and our clients in all of them.
Okay.
And amazingly, the worst performer of the 5 ran 22-1 in 5 years. The best performer, which was Paladin Resources, astonishingly went from 10 cents, where we did a private placement, to $10 in 6 years. And that was a particularly valuable lesson. And I'd like all of your listeners to pay particular attention to this narrative. When it was clear to me that the uranium price over time had only one way to go, while I was searching for ways to play the game, I came across Paladin Uranium, which was first of all in the uranium business, but importantly run by a real genius, a zealot named John Borshoff. John Borshoff had been in the uranium business for 30 years, so he had lots of experience. And importantly, when his prior employer, the government of Germany, had laid him off, he had taken his severance partially by their database. He acquired 30 years uranium exploration expenditure, over $1 billion from the government of Germany, for free. And so when I asked him what his exploration technique would be, he said, I'm just going to look in my files. I don't have to find uranium. I've already found hundreds of millions of pounds of uranium, and they're sitting there free for the staking. This will tell you how ugly bear markets are. But the rest of the story is even more instructive. Now, I was as excited by this narrative as you obviously are. Free uranium. I was rewarded for my genius, finding this $1.8 million market cap Western Australian nothing nowhere stock that nobody else had ever heard about. I was delighted with this. We financed them at a dime with all of our best clients and a lot of our own money. And we were rewarded for our genius by seeing the stock go from 10 cents to 12 cents, I think really a function of our foolishness. And then 10 cents again, okay. 8 cents, no big deal. 7 cents, troubling. 5 cents, not so good. 4 cents, ouch, this hurts. All the way down to a penny. If you buy a stock at 10 cents and it goes to a penny, there is no possibility of a hold. It is either a buy or a sell. And one must examine one's thought process. So I had occasion to rethink my whole thesis, both with regards to uranium and with regards to Paladin, and decide, was the market right and was I wrong, in which case I must take my licking and drive away, or was I right and was the market wrong, in which case I must buy more. Mercifully for me, my whole thesis was intact. What I learned was that I was early as opposed to being wrong. The consequence of that is that I had the courage of my convictions and bought a lot more stock at 1.5 cents and was rewarded with that market that moved as uranium moved, not from 10 cents to $1 or $2, but in fact from 10 cents via 1 cent to $10. Now, your listeners would be naive to believe that I still owned all of the stock that I had bought at 10 cents and later 1.5 cents at $10. Being down 90% is a traumatic event. And I did scale out of my position. But the truth is that is still the most dramatic financial event of my time. The more important lesson, though, is that, as I say, of the 5 uranium juniors that had survived that bear market, the worst performer went 22-1. There is another instructive lesson in this, if I may, for younger investors. You know, I said that at the beginning of that exercise, when the price of uranium had to go up, when there was no excuse not to be in the trade, nobody wanted to be in the trade. In fact, people were vilifying me for being in the trade. They weren't thinking of making money, and they weren't thinking of their lights going on. They were thinking of Hiroshima, Nagasaki, and 3 Mile Island. 5 years later, when the price of uranium had gone from $10 to above $100 and didn't have to go up anymore, in other words, when the investment thesis was much less compelling, people were interested. The price narrative, performance justified the narrative. And the people that had been vilifying me for participating were asking me literally for stock tips. At the same time, when the price of uranium didn't have to go up anymore, the numbers of companies that were looking for uranium increased from 5 to 500.
Wow.
At the top. Now, the truth is that there were probably 12 to 15 management teams that had survived a 20-year bear market in uranium. So when the investment thesis was popular, when there were 500 companies with investors throwing money at them, the probability of them throwing money at a viable management team was a simple function of dividing the number of management teams, say 15, by the number of aspiring companies, 500, which is to say at the top of the market, the lack of value was absolutely as compelling as the value had been at the bottom of the market, which is why I call uranium the ultimate contrarian speculation. Here we are, 20 years later, and past is prologue. We're back in a circumstance where the price of uranium at $30 a pound is substantially below the cost of production at $50 a pound, which is to say we're back in a circumstance where the price has to go up or else the lights go off. Those 500 pretenders looking for uranium has suddenly dwindled down to 15, which is to say that a 20-year bear market has, let's just say, culled the flock. And the third prior lesson is true too. The fact that the uranium price has to go up and that the surviving companies have to prosper is inevitable, but it's not necessarily imminent. So all of those lessons, I think, are important for your listeners to consider in terms of taking advantage of what I think will ultimately be another historic opportunity.
And how does the COVID-19 situation and Trump doing the $1.5 billion over 10 years, $150 million a year to make 25% of our nuclear supply come from U.S., how does all this updated type of information fit into your present view on the uranium market?
Two great questions. First of all, Trump and all politicians are ultimately not merely irrelevant, but in fact harmful. The fact is that markets work. The cure for low prices is low prices. And the very best possible thing our president could do is nothing. He should play golf. This isn't an attack on Trump, but rather an attack on executives, political executives that get in the way of the free activities between people. The cure for low prices is low prices. What Trump is doing is bribing certain constituencies in the United States by making U.S. uranium more expensive than other uraniums. There's no national security justification for what he's doing. It's likely to benefit a very, very, very small group of uranium companies, mercifully two of which I own. So
UU and UEC?
No comment. But as you say, it will benefit likely, if it comes to pass, small groups of companies. Your prior question was much more interesting to me. That is the impact of the virus. What I suspect that the virus will become, as we look back at it in history, is a pin that popped a bit of a balloon. The balloon being the economic expansion that we've enjoyed over the last 10 years. Some of that expansion was real, driven by technology, increases in efficiency, better capital utilization. But much of it was driven by politics and artificially low interest rates. And I would suggest that way too much of the economic recovery that we enjoyed in the last 10 years was false recovery that is driven by low interest rates. We needed to have a reckoning. We needed to have a slowdown that unwinded some of the expectations and excesses that we experienced over the last 10 years. I had been afraid that we were going to have a long, slow, boring, grinding recession. But COVID-19 fixed that. We had a sudden reset. Now, with specific regards to uranium, the virus and the unwinding of the economic expansion that preceded the virus demolished demand around the world. The most important near-term factor in the uranium price, as an example, is the pace of Japanese restarts. You see, the Japanese shut down their nuclear fleet post-Fukushima. And the biggest overhang of supply and the biggest deficit in demand is, in fact, Japan. The Japanese political and business establishment has long favored nuclear energy because going back as far as the Arab oil crisis in the 1970s, Japan has had a political ethos of energy security. And uranium is the most efficient fuel by volume in the world. A small amount of nuclear fuel, big enough to fit in a bowling alley, can fuel Japan's nuclear consumption for 6 or 7 years.
Wow.
The need to restart Japan's nuclear fleet, however, has been constrained by a slowdown in economic demand worldwide, which slows down demand for Japanese export products, which slows down demand for electricity in Japan, which reduces the need to restart their nuclear fleet. Further, the fuel that Japan has relied on as an alternative to nuclear power has been liquefied natural gas, a much less efficient fuel. But the current prices for energy means that substituting liquefied natural gas for uranium in the near term is much less painful than it had been 10 years ago. So the direct answer to your question is that the economic impact of the virus and the economic impact of unwinding, in particular, the excesses that have happened over the last 10 years has certainly delayed the prospects for recovery in uranium, simply because in the near term, the need for electricity is much less acute. It's important too, however, particularly important for your generation that has longer on Earth, to recognize that demand for all of resources, while it's fueled in the near term by rich countries, is driven in poor countries. Your generation needs to know that there are 7.7 billion people on Earth, all of whom aspire to enjoy the standard of living that you and I enjoy. And that standard of living is energy intensive and resource intensive. There are 7.7 billion mouths to feed. And when people aren't eating, especially in your generation, they're procreating, which means that there are more and more and more of these little consumers around, all of whom would like to live like you and I live. Now, one of the great stories of the last 30 years of my life has been the incredible pace of improvement of the living standards of the 2 billion people on Earth, who are the poorest of the poor. And this is great in every possible circumstance. All of humankind has to rejoice over the advanced living standards of the poorest of the poor. I'm not suggesting that they've come far enough, fast enough. I'm just trying to say that over 30 years, that's been a wonderful circumstance. What's important to remember in the context of resources is that when poor people become more rich, which they are doing rapidly, the goods that cause them the most utility are commodity intensive. When you get richer, you buy a service or you buy some little gizmo from Apple that has no resources in it. When poor people get rich, they take their per capita calorie consumption from 1,400 to 2,200. I'm not suggesting that obesity is a benefit, but it's certainly a choice. They upgrade their method of transportation from barefoot to sneakers, and sneakers to bicycles, and bicycles to 50cc motorcycles, and 50cc motorcycles to Toyota Hilux trucks. They replace a thatch roof with tin. And most of all, 1.3 billion people on Earth who don't have electricity covet electricity. The ultimate story with regards to resources and energy metals and uranium is the ascent of man. The near-term story is that it costs more to produce than it sells for, and it is 15%, pardon me, of U.S. baseload power. A question I love to answer.
So interesting. I thought, and I'm not an expert on it. I just am looking at this very rationally and saying, okay, so if a high percentage of the production's been shut down and it doesn't seem like it's going to go back online soon, I felt like that made it more bullish. And you're saying, in essence, it's made it less bullish because it shut down demand at the same time it shut down supply?
It's less bullish in the near term, more bullish in the long term. And that's what your constituency, your investor group needs to understand. This is inevitable, but it's not imminent. The fact that these shutdowns are longer means that ultimately the supply response will be less vigorous, which is to say that the price upside will be more vigorous. Ironically, the longer it takes for the thesis to play out, the more dramatic the response to the thesis will be. But your listeners who want to play this game have to have both the financial and the emotional responses to suffer through time and volatility between here and the point in time when their rational response gets validated by the market.
Yeah, and I think I've learned that a lot from you so far, especially with precious metals too, is that you need to believe in the thesis rationally, so much so that volatility up and down in the short term doesn't affect you, because it's, as you always say, it's a matter of when, not if. And when you understand it's a matter of when, at least I found from what I've learned from you so far over our relationship is it's helped me weather the emotional volatility, because it's a when, not if type of situation.
You and other young spokespeople for your generation have taught me that in terms of communicating with people substantially younger than myself, is that your generation has a couple of advantages over my generation. The first is informal distribution of information, which is to say you don't want it to be force-fed to you by the Los Angeles Times or CNBC or Fox for that matter. You'd prefer to rely on each other for information. The second is narrative. Your generation, I suspect, because you get so much information this way, as opposed to having it force-fed to you, is incredibly narrative-oriented. And that orientation towards narrative is the reason why I explained the Paladin story, because my suspicion is that the experience of the stock going from 10 cents to 1 cent and then 1 cent to $10, the process by which I had to reevaluate my premise, will resonate more with younger people than the arithmetic associated with selling a product for less than it cost you to produce it.
Yeah.
In fact, it's the realization of the impact on the person of the narrative that sticks in people's minds relative to, if you will, the raw math, which is the thing that appeals to some 67-year-old credit analyst like myself.
So what really caught my attention, and ever since you and I developed a relationship, I've watched all your presentations on uranium, never invested in it, and I understood the thesis. Wow, this makes a lot of sense. But it seemed like it seemed like a who knows when game. But then once the shutdown happened and I really started researching and seeing the incredible constraints that create the shortage and demand, and how this makes for a really impressive thesis if supply shut down to such a significant level. And then I started looking around, I'm going, how are the Paladin 7 cents, this company 11 cents? I'm like, how on earth it became so incredibly attractive to me? And I guess my next question is, how, for illustration purposes only, how do you advise someone to play this game if they do play the game?
Well, first of all, this is very self-serving, but I think that speculators need to talk to somebody who has been there before and experienced it. The truth is that you are going to have to focus in the near term less on the upside and more on the downside, which is to say, if you're going to position yourself now, you need to position yourself in those juniors who already have tier one deposits, not ones who have to find uranium, but ones who already have uranium. And you have to find uranium deposits that win what I call the last man standing contest. They have to be deposits that are, and this is not narrative, this is arithmetic, I'm sorry. They have to be in the best quartile in terms of return on capital employed and the lowest cost quartile. You also have to find companies that have balance sheets that can withstand at least 2 more years of torture, because it would be easy to experience 2 more years of torture before the bull market comes to us. So it's important that your listeners learn to play defense before they learn to play offense. There are 12 to 15 companies worldwide in various markets that we think are run by competent people. There are probably 4 juniors worldwide that we would condone owning in speculative accounts. The defining feature of a company that we would own in speculative accounts is a company that is either adequately capitalized now to survive 2 years, or a company that we would ourselves capitalize sufficiently that it could exist for 2 years, because it could easily require 2 more years in the wilderness before one came home to a bull market. Those young listeners of yours who are fortunate enough to be accredited investors, which is to say those investors who have built enough personal fortune that their portfolio exceeds $1 million and can participate in private placements, I think have a particularly attractive opportunity coming up in uranium. Every one of these juniors, I suspect, will have to raise additional equity in the next 2 years to survive until the bull market. The most efficient way to raise that equity is via private placements rather than public offerings. They're quicker, they're cheaper, and the truth is that there isn't the body of interest to justify a public offering. There's only a few people interested, and you can reach them privately. The beauty of private placements is that in addition to acquiring stock at a fixed price in a negotiated circumstance, very often you get warrants. Warrants being the right but not the obligation to purchase more stock at a fixed price over a period of time. If uranium stays unpopular for 2 years, and if the companies have to raise additional capital, and if they have to raise it from interested parties, my sort of fondest dream is that the only party that they have available to raise capital from is me. Which means that the terms that I can negotiate to provide that capital are more favorable to me and clients of ours than they would be in other circumstances. Will this fantasy of mine take place? I don't know. But it would seem like all the macro factors are lining up to have just this circumstance occur.
Interesting. So that's what I've been kind of trying to look around a little bit at cash reserves and burn money, basically. So you're saying, in essence, the companies that are most attractive are the ones that are already permitted. They already have their mines in place. Maybe they're not mining because the price is so low, or they stopped because of COVID-19, and they could quickly get back up onto their feet, as opposed to one that's selling the dream of exploration of, when this is big, we'll get big, but they don't have permitting, which could take 5 to 10 years and billions of dollars, and they don't have the mines. Is that what you're saying?
Ironically, I don't think they need to be permitted.
Okay.
What you learn is that when the price action justifies the narrative, the large companies will buy tier one deposits. What's important is that you buy deposits that can be financed and will be viable. In the next supply crisis in uranium, the financing for uranium developments will be provided by the utilities as much as by the markets. You see, increasingly to build a nuclear power plant, you're looking at upfront capital expenses between $5 and $8 billion. And in order to acquire the financing necessary to build the plant, you have to show the bank that you have access to supply. When supply gets tight, what I think will happen is that the plants themselves will finance mine construction in return for offtake, and having that contractual offtake will allow them to get the financing to build their plants. I realize it sounds circuitous, but my suspicion is that that's the way the market's going to play out, particularly in countries that recognize their need for increased generating capacity in particular, but also Korea, Taiwan, and India. I think you'll see circumstances where, because Western utilities already have contractual access to supply, these new plants will need to muscle their way into supply, and they will probably do that by financing new plant construction for the biggest and best deposits in the world.
So if you were getting started in uranium, what are the companies from a management and a cash balance perspective that are most attractive to you?
I probably can't say that because the SEC would probably construe it as investment advice.
Okay, got it.
If any of your listeners are interested in having the question answered, they can contact me at the email address you talk about. And after I harass them a little bit for some personal information that would allow me to quantify the advice I gave them, I'd be happy to try to answer the question.
I didn't give the email. I gave the website, sproutusa.com/ranking. So why don't you let everyone know email?
Well, I'll respond to that. That's the easiest way to do it. Just include in the byline uranium or something like that, and we'll try to respond.
So yes or no, seeing all of this happening with COVID-19 and all this type of stuff, I heard you talk about uranium before, and you sound excited about it, but you seemed like you didn't think it was going to be your expectations, or maybe not expectations, but your experience was so high from the last go around. You were like, it should be pretty good. Has this type of shutdown made it exceptionally more exciting to you for future prospects?
No, I don't think so. I think we've seen a circumstance where the catalyst is in place now. This dramatic increase in commodity prices means that what would otherwise have been a long, slow, grinding bear market becomes a short, bloody bear market. Oddly, I think it forward shifts the recovery because I think price discovery and supply shutdowns occur quicker than they otherwise would have. Make no mistake, I've always been excited about the uranium market. What I've come to learn, sadly, as an investor, is that although I, at 67, with less time on Earth, am substantially more patient than I was when I was your age with more time on Earth, that patience isn't shared by most. The most timely investment advice that I can give investors and speculators right now is gold and precious metals. We are already off the bottom. The wind is already in gold sails as a consequence of artificially low interest rates and quantitative easing and debt and deficits. That bull market happens first. I don't think that bull market will be as dramatic. I think it'll be a broader based bull market. The beauty of the uranium bull market is that the benefit in the uranium bull market will be concentrated among a very small number of names and will belong to a very small number of investors who get in early and suffer the same penalty for getting in early that I did. It wouldn't surprise me at all to see the prices of uranium stocks from here until the rebound. I'm not saying it's going to occur, but it wouldn't surprise me to see them fall 50%. I'm not saying they're going to.
Yeah.
But, the truth is that having the financial and psychological capability of withstanding a 50% decline in price takes a special kind of investor. From an arithmetic point of view, if the fundamentals haven't changed, an asset class that has a 50% decline in price is precisely twice as attractive. But it doesn't feel that way.
And I learned that from you, especially getting in so early in gold and silver and just watching it do nothing for so long and then go backwards. And so I had that first round of experience. But then, like you said, if it's half the price, it should be double as attractive. This isn't a random pull the slot machine gamble. This is really rational. Uranium powers 15-20% of base supply power. There's a huge supply shortage and there's only so many companies. And the reality is that it's going to need to go up in price because including finance, the cost is about 50 and it's priced at about 30. It's very rational. It's not like you're trying to get some penny stock that's for some random industry that has nothing to do with anything.
All of what you say is true, except that in the near term, we're over rather than undersupplied. We are producing less uranium than we are consuming, but we have substantial above ground stocks, in large measure, ironically, because of the price run-up that we enjoyed in the last sector. You'll recall that I said that high prices are the cure for high prices and low prices are the cure for low prices. And also, of course, the shutdown of the Japanese fleet. We are producing much less than we are consuming. And when we burn through the above ground stocks, I would suspect that the price response of the material will be, I love the pun, explosive.
And is there any way to estimate, or has your team been able to estimate how much above ground supply there is?
No, we've tried very hard. It's an extremely opaque market, and we've probably made inquiry of about 30 sources, and we've got 30 different opinions, which brings us back to that famous old Buffett quote: predictions tell you a lot about the predictor and not very much at all about the future.
That's good. Rick, this was fantastic. I know you're a busy man. I don't want to take up too much of your time, but I wanted to make this video because I found this so attractive as I started looking into it more and more and more. And so we're really lucky to have one of the most successful natural resources, uranium and gold, all around investors in the world in yourself, and truly do appreciate you taking the time. And I want to encourage all of our listeners to go ahead and go to sprottusa.com/rankings. Rick also has a fantastic YouTube channel with some of the staff from Sprott, with a lot of great content. Obviously, listening to Rick, you can't come away but thinking that he's one of the most objective, rational, and intelligent people I've certainly had the privilege of interacting with. And if you feel the same way, certainly go check out the rest of the videos from Sprott. It's a similar type of format where Albert, the co-host, is asking Rick a lot of really insightful questions about money, finance, and investments. And Rick is an open book with a lot of great information.
Jake, the world is a wonderful place. We, us old guys, we're sort of sitting around trying to determine how we could begin to share our message with millennials. And all of a sudden, you guys found us. Well, we were trying to figure out how to share our message. You showed us where to find our voice. And I'd like to reiterate the discussion of the link. I will personally rank your viewers' portfolios 1 to 10, 1 being best, 10 being worst. I will provide commentary where I believe my commentary is appropriate with regards to individual stocks in individual portfolios. Understand this isn't investment advice because I don't know you. I'm just talking about the companies. But I will include in the response to you a 45-year chart of the Barron's Gold Mining Index, which is the longest running and most inclusive gold index I could find, which will make a non-uranium point. It will make a point about the timeliness of precious metals and precious metals investing. And I'll also include a 100-year commodity chart which will speak volumes to the recovery in commodity prices that will be necessary over the next 5 to 10 years for all of us to sustain the standard of living that we enjoy today. I'd also like to tell you, pursuant to what you said about the Sprott Media YouTube channel, that very soon Albert and I will do a primer on uranium investing to go along with the gold investing primer and the silver investing primer that we did 2 weeks ago. So people who would like to explore the topic that you and I have just explored in a different format would be well advised to, probably the right thing to do would be to go to the Sprott Media YouTube channel and hit subscribe so that video will be automatically delivered to you when the time comes.
Fantastic. Thank you so much, Rick.
A pleasure. I look forward to catching sight of you personally when all this foolishness is